What's the difference between a lucky win and repeatable success? Kerry Packer won $20 to $40 million in Las Vegas. Was that luck or was that something else? Here's what most people miss. Packer didn't play for years and win once. He played one session and stopped. He didn't try to repeat it. He didn't push his luck. He executed a strategy, captured the gain, and exited. That's not gambling behaviour. That's institutional behaviour. That's how professional traders think about opportunities. Enter fast, capture the gain, exit before mean reversion. The same principles apply whether you're at a blackjack table or making investment decisions. Speed, timing, diversification, disciplined exits. These aren't gambling concepts, they're capital allocation concepts. Today, I'm going to break down exactly how Packer's approach mirrors how sophisticated investors approach markets. Not to teach you gambling, but to teach you how professionals think about timing and risk. The context. Let me establish something fundamental. This is not a gambling story. Professional investors study decision making in all contexts. Poker players have contributed to game theory. Chess grandmasters have influenced strategic planning. Military strategists have shaped competitive analysis. We study these contexts because clear decision-making principles emerge in high-pressure environments, and those principles transfer to investment contexts. Packer's Vegas session demonstrates principles of speed, timing, and exits in a compressed time frame. What takes months in markets happened in hours at a blackjack table. So we're studying decision making, not gambling. What happened?
The session happened at the MGM Grand. Reports indicate Packer won between $20 and $40 million in a single evening playing blackjack.
The details of how he played matter less than what he did after. He won, and then he stopped. He walked away. He left Las Vegas. He never attempted to recreate the session. This is the critical detail. The interesting decision wasn't playing, it was stopping. Most people would keep playing. They'd think, I'm hot, I should maximize this. They'd keep going until they lost it back. Packer did the opposite. He recognized favorable variance. He captured the gain. He exited before regression to the mean. That exit decision is what makes this interesting from an investment perspective, because knowing when to exit is the hardest part of investing.
Principle 1, speed as competitive advantage.
Packer made decisions quickly. He didn't deliberate extensively. He assessed situations and executed. In capital markets, speed is a competitive advantage, not recklessness, but because opportunities close quickly while you're analysing, someone else is executing. High-frequency trading firms invest billions to make decisions microseconds faster. That speed generates billions in profits. You're not competing at that level, but the principle scales. In every market, there's an optimal speed. Too slow, opportunities pass. Too fast, you make errors. Packer operated at the right speed. He had enough experience to assess quickly. He had enough capital that individual outcomes didn't matter. This is how professional investors operate. They do extensive preparation before opportunities emerge. They study companies, sectors, trends continuously, so when opportunity appears, they can move fast. Retail investors do the opposite. No preparation. Then when opportunity appears, they scramble to research. By the time they're ready, the opportunity has passed. Think about March 2020. Markets crashed. Professional investors had modelled pandemic scenarios. They had watch lists ready. When prices appeared, they executed immediately. Retail investors spent March reading, trying to understand. By the time they decided, markets had recovered 30 to 40%. Speed mattered, not reckless speed. Prepared speed, the kind that comes from doing work before you need to act. You can build your own framework. Study markets, understand sectors, create watch lists, model scenarios, Do preparation so when opportunity appears, you can act at the right speed. Principle 2, diversification within concentration. Packer was playing blackjack, which seems like concentrated risk, but he diversified within that context. He played multiple hands simultaneously. He varied bet sizes. He didn't put all capital into single outcomes. Even in concentration, he spread risk. This mirrors how professional investors think about position sizing. Even with high conviction, they don't put everything into it. They size positions based on confidence, volatility, and correlation. Hedge funds might have 20 to 30 positions, but sizes vary dramatically. High conviction might be 10% of portfolio, lower conviction 1 to 2%. This allows strong views while managing risk.
They also manage correlation. If you have 10 correlated positions, you don't have diversification. You have the same bet expressed 10 ways.
Packer understood this. By playing multiple hands and varying sizes, he spread risk across different outcomes. This applies to any investment context. If concentrated in a sector, diversify within it. Focused on growth stocks, vary company stages. In real estate, diversify by geography. Diversification doesn't mean you can't have conviction. It means expressing conviction intelligently with risk management. True diversification means sizing positions appropriately and ensuring positions aren't all correlated. Principle 3, exit timing determines results. This is the most important principle. Exit timing, knowing when to stop. This separates professionals from amateurs more than anything. Amateurs obsess over entry. What to buy, when to buy, at what price. Professionals focus on exits. They know entry timing matters less than exit timing. You can enter at mediocre prices and win if you exit well, but perfect entries don't help if you exit poorly. Packer demonstrated this perfectly. He entered, played, won, and then stopped. That stop decision was more important than everything before it. Why? Because in any probabilistic activity, short-term outcomes deviate from expected values. Variance dominates over short periods. Professional gamblers know this. They don't judge success by individual sessions. They judge by whether they're playing positive expected value strategies over time. But Packer wasn't a professional gambler. He was a capital allocator in a casino. He knew he'd experience favourable variance. Rather than assume it would continue, he exited. This is exactly how professional traders think. When a trade goes in your favour quickly, that's often favourable variance that won't last. The optimal response is often taking profits, not assuming the trend continues. Think about meme stocks, GameStop, AMC, explosive moves driven by momentum. Professional traders who caught those moves exited quickly. They took profits when variance was favourable. Retail traders did the opposite. They bought at peaks and held, expecting it to continue. Then they lost everything when mean reversion occurred. The difference was understanding when to exit. Professionals recognised favourable variance and captured it. Amateurs assumed it was the new normal. This is the hardest skill in investing, knowing when to exit winners, yet when to let them run versus when to take profits. Exit when the thesis changes. Exit when valuation becomes extreme. Exit when you see euphoria or panic. Exit when you find better opportunities. Packer exited because he recognised a favourable run. He didn't assume it would continue. He captured the gain and moved on. Most investors can't do this. They hold winners too long or sell too early. Neither is optimal. The optimal approach is having rules for exits and following them, not perfect rules, just consistent rules. Because exit discipline matters more than entry precision. The hit and run philosophy. There's a concept in professional trading called hit and run. Enter when you see opportunity, capture the gain quickly, exit before mean reversion. This is the opposite of buy and hold. It's not better or worse, just different and appropriate for certain conditions. Packer applied hit and run in Vegas. Enter, capture, exit. Don't overstay. This works in markets with momentum and reversion. Technology stocks often exhibit this. A stock pops on news, runs for days or weeks, then reverts. Hit and run traders capture momentum and exit before reversion. It also works for catalyst-driven investments. Merger arbitrage, activist situations. You enter when catalyst is announced, capture the spread, exit when catalyst completes. The key is recognizing which situations are hit and run versus buy and hold. Growth companies building advantages, buy and hold. Momentum plays driven by sentiment, hit and run. Most investors don't make this distinction. They apply the same approach to everything. That's suboptimal. Packer understood this. He wasn't building a long-term position. He was there for short-term opportunity. So he applied hit and run thinking. In your investing, ask, is this buy and hold or hit and run? The answer should influence your exit strategy. Discipline over optimization. Here's something critical. Packer's exit wasn't optimal. He could have kept playing and possibly won more. He left value on the table. But optimization wasn't the goal. Discipline was. Following a process. Sticking to strategy, not letting short-term results alter long-term approach. This is perhaps the most important lesson. Optimization is impossible. You can't time tops and bottoms perfectly. Trying to optimize leads to worse results. Discipline produces consistent results. Having rules and following them, not deviating based on emotion. That generates long-term success. Think about successful investment firms, Bridgewater, Renaissance, Two Sigma. They have rules, algorithms, processes. They follow them consistently. They don't optimize every trade. They execute their process correctly over thousands of trades. Consistency of execution produces success, not perfection of individual decisions. Packer showed this by walking away. He didn't try to optimize. He didn't aim for maximum possible winnings. He followed a rule. When you've had a strong session, exit. That rule wasn't optimal for that specific night, but following it consistently is optimal over time. Most investors have no rules. They make each decision based on current emotion. That's guaranteed to fail. Build rules, simple rules. I sell when position reaches 50% of portfolio. I exit when valuation exceeds 40 times earnings. I rebalance quarterly. These won't be optimal for every situation, but following them consistently beats trying to optimize each decision. Discipline beats optimization. Applying to real investing. How do you apply these principles to actual investing? First, speed. Do preparation in advance. Build watch lists of companies you want at certain prices. Model scenarios before they happen. Create frameworks for decisions. This allows quick action when opportunities emerge. Don't wait until opportunity appears to start researching. That's too late. Preparation happens continuously, so execution can be instant. Second, diversification. Even when concentrated, spread risk intelligently. Focused on a sector, own multiple companies at different stages. Concentrated in growth, include some value. All stocks, consider bonds or alternatives. The goal isn't diversifying so much you own everything. It's diversifying enough that no single position can destroy you. Third, exit discipline. Develop rules for when you exit. Not vague, like when it feels right. Specific. When it reaches 2 times my cost. When valuation exceeds sector median by 50%. When thesis changes, these won't be perfect, but having them and following them beats having no rules and making emotional decisions. Fourth, hit and run versus buy and hold. Recognise which investments are which. Some are long-term compounders. Hold them for years. Others are short-term catalysts. Capture the move and exit. Don't apply the same strategy to everything. Match approach to situation. Fifth, discipline over optimization. Accept you'll leave money on the table sometimes. You'll exit winners that keep winning. You'll miss absolute tops and bottoms. That's fine. Consistency matters more than perfection. These aren't gambling principles. These are institutional investment principles. Speed, diversification, exit discipline, hit and run thinking, process over outcomes. Packer demonstrated them in a casino, but they apply everywhere capital is deployed. The psychological component, most people can't walk away from winners. They get anchored to recent success and expect it to continue. This is recency bias. Recent events feel more predictive than they are. You win a few trades, you feel like you can't lose. You take larger risks, assuming the streak continues. Professional investors overcome recency bias through process. They don't judge by recent results. They judge by whether they followed their process. Did they execute correctly? Did they follow rules? Did they make decisions for the right reasons? If yes, it was a good day regardless of P&L. This psychological discipline is harder than technical analysis. It requires self-awareness and emotional control. Packer had this discipline. He'd won and lost fortunes multiple times. He wasn't psychologically attached to any individual outcome. That detachment allowed him to walk away. He didn't think, I'm hot, I should keep playing. He thought, I've had a favourable run, I should capture it. You can develop this maturity. It requires experience, self-reflection, and commitment to process over outcomes. Start by tracking decisions separately from results. Did you follow your process? Did you execute correctly? Judge yourself on that, not on whether you made money. Over time, this builds psychological discipline to walk away from winners, cut losers, and make decisions based on strategy rather than emotion. When speed matters. Let's go deeper on speed. When does it actually matter in markets? Speed matters when opportunities are time sensitive. Earnings releases, economic data, regulatory changes, merger announcements. These create brief windows where information isn't fully priced. Professional traders position in advance or react within seconds. Retail investors react hours or days later after the opportunity is closed. Speed also matters in momentum situations. When a stock breaks out, early buyers get best prices, late buyers get momentum chased and lose when it reverses. But speed doesn't always matter. For long-term value investors, speed is irrelevant. If you're buying to hold for 10 years, whether you buy this week or next doesn't matter. The skill is knowing when speed matters. For your strategy and time frame, when are decisions time sensitive? Optimize speed for those situations. Packer's situation was highly time sensitive. Decisions happened in seconds. Speed was essential. Identify which of your decisions are similarly time sensitive and develop ability to act quickly in those contexts. The real lesson, institutional thinking. Here's what ties this together. The lesson isn't about specific tactics. It's about thinking institutionally rather than emotionally. Institutional investors have processes, rules, frameworks. They make decisions systematically, not impulsively. They separate emotion from analysis. They focus on long-term results, not short-term outcomes. Retail investors do the opposite. They make decisions emotionally. They chase recent winners. They panic during drawdowns. They have no process. They judge success by last month's returns. That difference in thinking produces different results. Institutional investors generate consistent returns over decades. Retail investors underperform markets by several percent annually. You can think institutionally regardless of capital. It's not about size, it's about approach. Do you have a process? Do you follow rules? Do you separate emotion from decisions? Do you focus on long term? If yes, you're thinking institutionally. If no, you're thinking emotionally. Packer thought institutionally. He had rules for when to enter, how to play, when to exit. He followed them. He didn't let excitement alter his process. That's the transferable lesson. Build processes. Follow them. Don't deviate based on emotion or recent results. Think long term. Separate decisions from outcomes. This is how professionals win consistently. Not by being smarter or having better information, by having better processes and following them more consistently. Final thoughts. What's the difference between lucky wins and repeatable success? Lucky wins are random. They can't be recreated. They depend on favourable variance that can't be predicted or controlled. Repeatable success comes from process, from making good decisions consistently, regardless of outcomes, from having rules and following them, from thinking systematically rather than emotionally. Packer's Vegas session combined both. He had favourable variance. But he also executed a disciplined process. Enter, play strategically, exit at the right moment. The favourable variance created the size of the win. The disciplined process allowed him to capture it. In your investing, you'll experience both. Sometimes you'll get lucky. Markets will move in your favour for random reasons. When that happens, recognise it and capture it. Don't assume it's skill or expect it to continue. Other times, you'll make good decisions that produce poor short-term results. That's also variance. Don't abandon your process because of short-term bad luck. Focus on what you control, your process, your decisions, your discipline. Results over short periods are heavily influenced by luck. Results over long periods are determined by process quality. Kerry Packer understood this completely. He knew he'd gotten lucky, but he also knew that walking away was a disciplined decision. That's the lesson. Not go to Vegas, not try to get lucky, but build disciplined processes and follow them consistently, capturing favourable variance when it appears and not giving it back when mean reversion occurs. That's how sophisticated investors think. That's how institutional capital works. That's how you build repeatable success rather than relying on lucky wins. The principles are simple: speed, diversification, exit discipline, hit and run when appropriate, process over outcomes. These work in any context where capital is deployed. Packer demonstrated them at a blackjack table. You can apply them in markets, business, or anywhere strategic decisions determine results. Build processes, follow them, think institutionally. That's how you turn occasional luck into consistent success.